when we think about high yield, it's below triple B minus, so we call it sub-investment grade. So it's anywhere down to from double B plus down to triple C. Most of the high yield market, though, is made up of double B credit. And that's a change from over the past 5 to 7 years. Yeah. And the reason for that is there's been a lot of the borrowers that would have brought more leverage to that market have done it in the private lending market, yeah. even the leveraged loan market, but in the private lending. That's where most of the leverage is going into. Private direct lending.
So does this concern you? Because I know that you're into private markets as well, and these days when folks talk about private credit, right? Yeah. The old joke is like, I mean, this is leverage upon leverage upon leverage. How risky is it in that space?
So the risk lies in the view on where pricing should be. Right, so if it's a private credit instrument, you lack the liquidity to be able to trade it. So you can't take advantage of price moves as you can with something that's syndicated like leveraged loans and high yield. And you also don't know about the underlying fundamentals of the companies because again, they're private. So there's a lot that's left that you have to be very trusting of the manager. And there's been a lot more leverage that's been put into that market. 80% of the deals that were taken from high yield and leveraged loans, so these deals that need to be refinanced, 80% of those were low single B or triple C. So that's where most of the lower quality, the bonds that you really don't want to kind of stay away from in high yield and leveraged loans, they're going into private direct lending.
How volatile or how dangerous is it in private credit right now? I mean, the economy looks like it's in fairly good shape, and we'll get the latest read when the jobs report drops on Thursday ahead of 4th of July, right, day early. Yep. But, if there is even an outside risk of a recession happening, private credit, is that going to be the next shoe to drop?
Private credit will be one of the shoes to drop. Look, recession is not great for any leveraged credit companies, including high yield and in leveraged loans. But I think what the thing is you're not being able to see is the performance in private direct lending. Because to see the defaults, they'd have to be announced, and these are private companies. But what's more taking shape is there's a lot of PIK loans that go into private direct lending. And these are bonds that instead of paying coupon, they pay more of the same principal amount. So companies or lenders can just continue that PIK instead of receiving cash. And that becomes a large part of the market in private direct lending. And they're not receiving any cash for those. So you start to get more PIK. Now, is that a default if they're starting to pay you that? Or can you just kind of pretend and keep going with that? That's the part that becomes a little more opaque.